You know what's fascinating? I spend about an hour every day analyzing markets, and I can't tell you with any confidence what's going to happen in the next 6 months. But I can tell you with a very high degree of certainty what the world will look like in 10 years. And yet, most investors do exactly the opposite. They obsess over the next earnings report, the next Fed meeting, the next election. And they completely ignore the massive structural shifts that are going to reshape the entire investment landscape over the next decade. That's not investing. That's gambling with a longer time horizon. Before we dive deeper into this, if this kind of long-term structural thinking resonates with you, please take a moment to like this video and subscribe to the channel with notifications enabled. It helps us reach more people who understand that real wealth is built on decades, not quarters. Now, let me be clear about what I'm saying. Short-term analysis has its place. I run BlackRock. We manage over $11 trillion. We have teams that monitor every tick in the market, every data release, every central bank statement. We need that information to manage risk, to execute trades efficiently, to serve our clients. But that's operational. That's tactical. It's not strategic. And when I think about where to allocate capital for the long term, when I think about the investments that are going to define wealth creation over the next decade, I barely think about the short-term noise at all. Here's why. The things that matter most over 10-year periods are not the things that fluctuate day to day or quarter to quarter. They're structural, they're demographic, they're technological, they're geopolitical, and most importantly, they're knowable. Not with certainty, but with enough confidence to build investment theses around. You can see them developing. You can understand the forces driving them. You can position yourself to benefit from them. But only if you're looking at the right time horizon. Let me give you an example. 10 years ago, in 2015, could you have predicted with confidence where the S&P 500 would be in 2016? No. Too many variables. Too much noise. Central bank policy, earnings surprises, geopolitical events, all of it unpredictable. But could you have predicted with confidence that the world would be more digitally connected in 2025 than it was in 2015? Absolutely. Could you have predicted that renewable energy would be a larger share of the energy mix? Yes. Could you have predicted that populations in developed countries would be older and that aging would drive massive demand for healthcare? Of course. Those weren't guesses. Those were structural certainties. And if you positioned your portfolio around those certainties, if you owned technology infrastructure, if you owned renewable energy assets, if you owned healthcare and pharmaceutical companies, you did extremely well. Not because you predicted quarterly earnings. Not because you timed the market. But because you understood the direction of structural change and you aligned your capital with it. This is the distinction most investors miss. They're trying to predict fluctuations when they should be understanding trends. They're trying to time markets when they should be riding secular waves. And the tragedy is that the secular waves are so much easier to identify and so much more profitable over time. But they require patience. They require looking beyond the noise. And most people can't do that because they're psychologically wired to focus on what's immediate and uncertain rather than what's distant and certain. I've seen this pattern play out over and over again across almost 50 years in this business. In the 1980s, people were obsessed with the Cold War and whether the Soviet Union would collapse. That uncertainty dominated headlines, dominated investor sentiment. But the real story, the structural story, was globalization. The opening of markets. The integration of global supply chains. The shift of manufacturing to lower-cost regions. If you understood that trend, if you positioned for it, you made enormous wealth regardless of what happened with the Soviets on any particular day. In the 1990s, the short-term obsession was Y2K. People were genuinely worried that computers would fail, that the financial system would crash, that planes would fall from the sky when the calendar turned to 2000. It dominated conversation. And it was completely irrelevant. The real story was the internet. The digitization of information. The creation of entirely new business models. If you were worried about Y2K, you missed the opportunity. If you understood the structural shift toward digital infrastructure, you captured it. In the 2000s, the short-term focus was terrorism, Iraq, weapons of mass destruction, constant fear, constant uncertainty. But the structural story was the rise of emerging markets, particularly China and India. The biggest wealth creation opportunity of that decade wasn't predicting whether the Fed would cut rates by 25 or 50 basis points. It was understanding that billions of people were entering the global middle class and that this would drive demand for commodities, infrastructure, and consumer goods. And right now, in 2025, I see the same pattern. People are obsessed with whether the Fed will pause rate hikes, whether inflation is truly under control, whether we're heading into recession. These are important questions operationally. But they're not the questions that will determine whether you build wealth over the next decade. The questions that matter are, how will artificial intelligence reshape productivity and labor markets? How will the energy transition from fossil fuels to renewables play out? How will demographic aging in developed countries create investment opportunities and fiscal challenges? How will geopolitical fragmentation reshape supply chains and trade flows? These are the structural forces. These are the trends you can see developing. These are the areas where you can position capital with high conviction because you're not betting on a specific outcome in a specific quarter. You're aligning with a direction of change that's going to unfold over years regardless of short-term volatility. Let me be specific about what I mean. Artificial intelligence. I can't tell you which AI company will dominate in 2026. I have no idea. There's enormous uncertainty about who the winners and losers will be in the short term. But I can tell you with very high confidence that AI will increase productivity across almost every sector of the economy over the next decade. I can tell you that companies that effectively deploy AI will have a massive advantage over companies that don't. I can tell you that the infrastructure required to power AI, the data centers, the semiconductors, the energy, all of that will see sustained demand growth. So how do I invest around that? I don't try to pick the winning AI startup. I own the infrastructure. I own semiconductor companies that make the chips AI runs on. I own data center rights. I own utilities that power those data centers. I own broad index funds that include all the companies deploying AI to improve their operations. I'm not making a bet on a specific company. I'm making a bet on a structural trend. And that bet doesn't require me to be right about the next 6 months. It requires me to be right about the next 10 years. And I am right about the next 10 years because the trend is undeniable. Energy transition. Same logic. I can't tell you what oil prices will be next quarter. Too many variables. OPEC decisions, geopolitical tensions, economic growth, all of it creates short-term noise. But I can tell you with high confidence that the share of global energy coming from renewables will be significantly higher in 2035 than it is today. Why? Because the cost curve for solar and wind has fallen dramatically. Because governments worldwide have committed to net zero targets. Because corporate buyers are demanding clean energy. Because the technology is proven and scaling. So I don't try to trade oil prices. I don't try to predict when the energy transition will accelerate or decelerate quarter by quarter. I own renewable energy infrastructure. I own companies building wind farms and solar arrays. I own battery storage companies. I own utilities that are transitioning their generation mix. I own the grid infrastructure that's being upgraded to handle distributed energy. I'm positioned for the structural shift. And again, that doesn't require me to predict short-term movements. It requires me to understand long-term direction. Demographics. This is probably the most certain structural force there is. We know with near certainty how many people will be over 65 in the United States in 2035. They're already born. They're already aging. We know they'll consume more healthcare. We know they'll need more elder care. We know they'll draw down savings rather than accumulate. We know they'll create fiscal pressure on Social Security and Medicare. We know all of this with extremely high confidence. So how do I position around that? I own healthcare companies. I own pharmaceutical companies with drugs for chronic conditions that affect older populations. I own senior housing rights. I own companies that provide home healthcare services. I'm not predicting which specific drug will get FDA approval next year. I'm positioning for the fact that healthcare spending as a share of GDP is going to rise, and companies exposed to that spending will benefit. Geopolitical fragmentation. This one is harder because it's more uncertain, but the direction is still clear. We're moving from a highly globalized world with deeply integrated supply chains to a more fragmented world where countries prioritize resilience and security over pure efficiency. We're seeing reshoring, nearshoring, friendshoring. We're seeing countries build domestic capacity in critical industries. We're seeing trade relationships restructure along geopolitical lines. I can't tell you exactly how this plays out. I can't tell you which specific countries benefit most or which industries get reshored first. But I can tell you with confidence that companies with diversified supply chains will be more resilient than companies dependent on a single region. I can tell you that manufacturers in certain regions, Mexico for nearshoring to the US, Vietnam for diversification away from China, will see investment inflows. I can position for that trend without needing to predict every twist and turn. Now, Here's the psychological challenge. These structural trends play out slowly. They don't generate excitement. They don't give you the dopamine hit of a stock that doubles in 3 months. If you buy infrastructure assets that benefit from the energy transition, you might earn 8% or 10% annually over a decade. That's phenomenal compounding. That's wealth creation. But it's boring day to day. There's no drama. There's no story to tell at a dinner party. And most investors can't handle boring. They need action. They need to feel like they're doing something. So they trade. They chase momentum. They react to headlines. They convince themselves they can predict the unpredictable. And they systematically underperform patient investors who just align with structural trends and hold. I see this at BlackRock all the time. We have clients who've been with us for 20, 30 years. They invested in our index funds, they stayed invested through multiple recessions and bull markets, and they've built enormous wealth. Not because they were brilliant. Not because they had access to special information. But because they understood that structural equity market growth over decades is one of the most reliable wealth-building mechanisms in human history. They didn't try to time it. They just participated in it. And then I see other investors, often very smart people, who constantly adjust their portfolios based on short-term views. They sell when they think a recession is coming. They buy when they think the coast is clear. They rotate sectors based on Fed policy expectations. And over time, they underperform. Not because their analysis is wrong. Often their analysis is quite good. But because the timing is nearly impossible to get right consistently, and the transaction costs and tax consequences of all that activity eat away at returns. Here's a specific example that illustrates this. From 2010 to 2020, the S&P 500 returned about 13.5% annually. If you just bought an index fund in January 2010 and held it through December 2020, you captured that entire return. Your $1 million became about $3.5 million. But if you missed just the 10 best days during that decade, days when the market surged unexpectedly, your return dropped to about 7.5% annually. Your $1 million became about $2 million. You gave up $1.5 million by being out of the market for just 10 days out of 2,520 trading days. And when do those best days typically occur? Right after the worst days. During periods of extreme volatility and fear. If you sell because you're worried about short-term uncertainty, you almost inevitably miss the recovery. You time yourself out of the gains. This is why obsessing over short-term predictions is so dangerous. It causes you to make decisions that feel prudent in the moment but are devastating over time. Now, let me address an objection I hear constantly. People say, "Larry, that's easy for you to say. You're rich. You can afford to think long-term. I need returns now. I can't wait 10 years. And I understand that sentiment, but it's based on a misunderstanding of what long-term investing actually means. Long-term investing doesn't mean you ignore your portfolio for 10 years. It doesn't mean you don't need liquidity or income. It means you build a portfolio with a long-term strategic core that aligns with structural trends, and you manage around that core for your near-term needs. If you need income, you create an income stream from dividends or bond coupons or a withdrawal strategy. If you need liquidity, you maintain a cash buffer. But you don't sacrifice the long-term structural positioning because of short-term tactical concerns. Most people do this backwards. They build a portfolio based on short-term views and then hope it somehow works out long-term. That's not a strategy. That's luck. The right approach is to build the long-term strategic foundation first, the exposure to structural trends that you have high conviction about, and then layer on the tactical elements needed to manage short-term volatility and liquidity. At BlackRock, when we build portfolios for long-term institutional clients like pension funds and endowments, this is exactly how we think about it. We identify the structural themes, the secular growth opportunities, the demographic shifts, the technological disruptions. We build core allocations around those themes. And then we use tactical overlays to manage risk and generate income and maintain liquidity. But the tail never wags the dog. The short-term tactics serve the long-term strategy, not the other way around. And here's what's critical. The structural themes I'm talking about are not predictions. They're observations about forces already in motion. AI is already transforming industries. The energy transition is already happening. Populations are already aging. Geopolitics are already fragmenting. These aren't bets on what might happen. These are responses to what is happening, just at a pace that's too slow for daily headlines but too important to ignore for long-term wealth. So here's my challenge to you. Step back from the daily noise. Stop checking your portfolio every day. Stop reacting to every Fed statement and every earnings report. Instead, spend time thinking about what the world will look like in 2035. What industries will be bigger? What problems will need solving? What demographic groups will have the most spending power? What technologies will be ubiquitous? What geopolitical realities will shape trade and capital flows? If you can develop conviction around those questions, if you can identify a few structural trends that you genuinely believe in, you can build a portfolio that aligns with those trends. And then you can have the discipline to hold that portfolio through short-term volatility, through recessions, through bear markets, through all the noise that causes other investors to panic and trade. Because you're not betting on the next 6 months. You're positioning for the next 10 years. And that requires a completely different mindset. In the next section, I'm going to walk you through the specific structural themes I have the highest conviction about right now. I'm going to explain the forces driving each theme, the ways you can gain exposure, and the common mistakes people make when trying to invest around long-term trends. And I'm going to give you a framework for distinguishing between genuine structural shifts and temporary fads, because not every trend is worth investing in, and knowing the difference is critical. Let me walk you through the structural themes that I believe will define the next decade of wealth creation. Not because I have a crystal ball, but because these forces are already in motion, already measurable, and already creating investment opportunities that most people are missing because they're focused on the wrong time horizon. First major theme: the infrastructure deficit and the capital expenditure supercycle. Here's what most people don't understand. The developed world massively underinvested in infrastructure for about 30 years. From roughly 1990 to 2020, we built very little. We maintained what we had, barely, but we didn't expand capacity. Meanwhile, demand kept growing. Populations increased. Economic activity increased. And now we have a gap. A massive gap between the infrastructure we have and the infrastructure we need. This shows up everywhere. The electrical grid in the United States was largely built in the 1950s and 60s. It's outdated. It can't handle the load from electric vehicles, from data centers, from the electrification of everything. We need to rebuild it. That's hundreds of billions of dollars of investment over the next decade. Roads, bridges, airports, water systems, all of it is aging, all of it needs replacement or expansion. And that's just traditional infrastructure. Now add the new infrastructure we need. Data centers to support AI and cloud computing. Semiconductor fabrication plants because we've realized supply chains are vulnerable. Renewable energy generation and transmission. Battery storage. Hydrogen production facilities. Carbon capture infrastructure. This is a multi-trillion-dollar capital expenditure cycle that's just beginning. And it's going to play out over 10 to 15 years regardless of what happens to the economy quarter to quarter. How do you position for this? You own the companies that build infrastructure. Engineering firms, construction companies, materials suppliers. You own the infrastructure assets themselves. Utilities that are upgrading their grids. Toll roads and airports. Data center rights. You own the financing mechanisms. Infrastructure debt funds that lend to these projects at attractive yields. This is not speculative. This is investing in the picks and shovels of a structural building boom. And here's the beautiful part. Infrastructure investments generate predictable cash flows. They have long-duration contracts. They often have inflation escalators built in. They're not volatile like tech stocks. They're boring, steady, compounding machines. Exactly the kind of assets that work well in a portfolio designed for the long term. Second major theme: the reshaping of global supply chains. For 30 years, globalization meant optimizing for cost. You manufactured where labor was cheapest. You sourced components from wherever they were most efficient. You built just-in-time supply chains with minimal inventory. And it worked beautifully until it didn't. Until the pandemic exposed how fragile those supply chains were. Until geopolitical tensions made clear that depending on a single country for critical goods was a strategic vulnerability. Now we're in a different era. Companies are prioritizing resilience over pure efficiency. They're diversifying suppliers. They're bringing production closer to end markets. They're building redundancy even though it costs more. This is reshoring, nearshoring, friendshoring. And it's a structural shift that will play out over the entire decade. What does this mean for investors? It means manufacturing is coming back to certain regions. Mexico is becoming a manufacturing hub for goods sold in North America. Vietnam, India, and other Southeast Asian countries are becoming alternatives to China for certain types of production. Even the United States is seeing manufacturing investment in semiconductors, in batteries, in pharmaceuticals. This creates opportunities in industrial real estate, in logistics, in the companies that facilitate this transition. It also means higher costs, which feeds into inflation, which has implications for how you structure fixed income portfolios. But more fundamentally, it means the geography of production is changing, and being positioned in the right geographies, either through direct investments or through companies operating there, will generate outsized returns. Let me give you a specific example. Semiconductor manufacturing. For decades, the cutting-edge chips were made almost exclusively in Taiwan and South Korea. The US basically exited the manufacturing side of the business. But now, with geopolitical concerns about Taiwan and the strategic importance of semiconductors, there's a massive push to build fabrication capacity in the United States and Europe. Intel is building new fabs. TSMC is building fabs in Arizona. Samsung is expanding in the US. This is tens of billions of dollars of capital expenditure creating construction jobs, equipment orders, and eventually production capacity. If you own the equipment companies that supply the tools to build these fabs, you benefit. If you own the materials companies that supply the chemicals and gases used in manufacturing, you benefit. If you own the construction and engineering firms building the facilities, you benefit. You don't need to predict which chip company wins. You just need to understand that the fabs are getting built, and that creates a chain of demand. Third major theme. The aging of developed country populations and the healthcare spending boom. This is the most certain structural trend I know of. We can look at birth rates from 30, 40, 50 years ago and project forward with near certainty how many people will be over 65, over 75, over 85 in any given year for the next several decades. And the numbers are staggering. In the United States, the 65-plus population is growing faster than any other age group. By 2030, all baby boomers will be over 65. By 2035, there will be more people over 65 than under 18 for the first time in American history. Similar patterns are playing out in Europe, Japan, China. Aging populations create specific, predictable investment opportunities. Healthcare spending rises dramatically with age. The average person over 65 spends 3 to 5 times more on healthcare than the average person under 65. Chronic conditions like diabetes, heart disease, cancer, dementia, they all increase with age. This means sustained demand growth for pharmaceuticals, medical devices, hospital services, diagnostic equipment. It means growing need for eldercare, both in facilities and at home. It means demand for companies that make healthcare more efficient, because the fiscal burden of this spending is going to strain government budgets. How do you invest around this? You own pharmaceutical companies with strong pipelines in areas that affect older populations. Cardiovascular drugs, oncology, Alzheimer's treatments. You own medical device companies. Hip and knee replacements, cardiac devices, insulin pumps. You own senior housing rights. Assisted living, memory care, skilled nursing. You own home healthcare companies. You own health insurers, though with some caution because of regulatory risk. You own companies leveraging AI to make healthcare delivery more efficient. This is not a trade. This is a decade-plus structural position. The demographics are locked in. The spending patterns are well understood. The only question is which specific companies execute best, and you can mitigate that risk through diversification. Fourth major theme. Energy transition and the massive capital requirements of decarbonization. I've talked about this before, but let me emphasize the scale. The world needs to get to net zero carbon emissions by 2050 to avoid the worst impacts of climate change. That requires rebuilding essentially the entire energy system. We need to replace fossil fuel power generation with renewables. We need to electrify transportation. We need to electrify heating. We need to build massive amounts of battery storage. We need to upgrade the grid. We need to develop green hydrogen for industrial processes. We need carbon capture technology for the emissions we can't eliminate. The capital required to do all of this is measured in the tens of trillions of dollars. And unlike some structural themes that depend on consumer behavior or technological breakthroughs, this one has massive policy support. Governments around the world have committed to net zero targets. They've passed legislation providing subsidies, tax credits, mandates. The Inflation Reduction Act in the US alone provides nearly $400 billion in clean energy incentives. Europe has similar programs. China is investing massively in renewables and EVs. This creates a sustained tailwind for companies across the entire value chain. Solar panel manufacturers, wind turbine makers, Battery producers. Electric vehicle companies, though with significant risk because competition is fierce. Grid infrastructure. Energy storage. Companies that manage the complexity of integrating distributed renewable energy into the grid. Utilities that are transitioning their generation mix from coal and gas to renewables. And here's a nuance most people miss. The transition doesn't happen overnight. It takes decades. That means fossil fuel companies don't disappear. Some of them will successfully transition to become energy companies rather than just oil and gas companies. Some will generate enormous cash flows during the transition and return that capital to shareholders. Understanding which companies are positioned for the transition rather than fighting it, that's where the opportunity is. Let me also mention the criticality of natural resources. The energy transition requires massive amounts of copper, lithium, nickel, cobalt, rare earth elements. The supply of these materials is constrained. Bringing new mines online takes years, sometimes a decade or more. Demand is growing faster than supply in many cases. This creates opportunities in mining companies, in recycling companies that recover these materials, in companies developing technologies to use less of these scarce inputs. Fifth major theme. Artificial intelligence and the productivity transformation. I mentioned this earlier, but let me go deeper. AI is not like previous technology cycles. It's not a product. It's a capability that gets embedded in everything. It makes workers more productive. It makes processes more efficient. It enables things that weren't possible before. We're at the very beginning of this. Right now, AI is being deployed in narrow applications. Customer service chatbots, code writing assistants, image generation. But over the next decade, it's going to permeate every industry. Healthcare, where AI helps with diagnosis and drug discovery. Finance, where AI improves risk management and trading strategies. Manufacturing, where AI optimizes production and supply chains. Education, where AI personalizes learning. The productivity gains from this are potentially enormous. Some estimates suggest AI could add several percentage points to GDP growth annually once it's widely deployed. That's the difference between mediocre economic performance and a boom. And the companies that effectively leverage AI will have massive competitive advantages over those that don't. But here's the challenge for investors. It's very hard to predict which specific AI companies will win. The technology is moving fast. Competition is intense. Today's leader could be tomorrow's laggard. So how do you invest in a theme where you have high conviction about the trend but low conviction about individual winners? You invest in the infrastructure. The semiconductor companies making the GPUs and specialized AI chips. The cloud providers hosting the compute. The data center rights. The utilities powering those data centers. You invest broadly across companies using AI, through index funds or sector funds. You avoid trying to pick the specific AI startup that will dominate, because that's speculation, not structural investing. And you think about second-order effects. If AI dramatically increases productivity, what does that mean for inflation? For labor markets? For interest rates? For wage growth? These are the questions that will shape the broader investment landscape, and they're more important than betting on any single AI company. Now, here's how these themes interact, because that's where it gets really interesting. The infrastructure build-out requires enormous amounts of materials, which benefits commodity producers. The energy transition requires grid upgrades and new power generation, which benefits utilities and infrastructure. AI requires data centers, which require energy, which increases demand for renewable capacity and creates pressure on the grid. The aging population requires healthcare, which increasingly uses AI for efficiency. The reshoring of manufacturing requires building factories, which is infrastructure. These themes reinforce each other. They're not independent bets. They're interlocking structural forces that create a web of opportunities. And understanding how they connect, how progress in one area drives demand in another, that's how you build a portfolio with multiple ways to win. Let me give you a practical example of how I think about this. I own utilities, both traditional and renewable focused. Why? Because electricity demand is going to surge from EVs, from data centers, from electrification of heating. I own data center rights. Why? Because AI and cloud computing require massive data center capacity. I own semiconductor equipment manufacturers. Why? Because chip demand is structural, driven by AI, by reshoring manufacturing, by the increasing electronic content in everything from cars to appliances. I own healthcare companies with strong positions in chronic disease management. Why? Because demographics guarantee demand growth. I own infrastructure debt funds. Why? Because governments and companies need to finance the massive build-out, and debt investors can earn attractive yields from long-duration, contracted cash flows. I own broad international equity exposure, tilted toward countries positioned to benefit from supply chain diversification. This isn't a collection of random bets. It's a portfolio structured around high-conviction structural themes. And critically, it doesn't require me to be right about what happens in the next 6 months. These themes play out over years. Some will develop faster than expected, some slower, but the direction is clear, and being positioned for the direction is what matters. Now let me give you the framework for actually implementing this structural approach to investing, because understanding the themes is only half the battle. The other half is having the discipline to stick with them when everyone around you is chasing short-term momentum or panicking over quarterly noise. First principle. Structural investing requires patience, and patience requires conviction. You can't maintain a 10-year position in something you don't truly believe in. When the position is down 20% in year 2 because of some temporary headwind, you need to be able to look at it and say, the structural thesis hasn't changed. This is noise, but you can only do that if you did the work up front to really understand why you own the position. This is why I spend time on fundamental analysis of structural themes. I don't just read a headline and decide AI is important. I dig into the technology, the adoption curves, the economic incentives, the regulatory environment, the competitive dynamics. I build a mental model of how the theme will develop over time. And then when there's volatility, when there's a setback, I can evaluate whether the setback invalidates my thesis or whether it's just part of the normal evolution. Most investors don't do this work. They hear about a theme, they buy an ETF, and they have no real conviction. So when it underperforms for 6 months, they sell and move on to the next thing. They're thematic tourists, not thematic investors. And they never capture the real gains because they never hold long enough. Here's a concrete way to build conviction. Write down your thesis. Not just, AI is important, but a detailed explanation of why the theme matters, what the drivers are, what could go wrong, what would make you change your mind, and what your expected time horizon is. If you can't articulate this clearly on paper, you don't understand the thesis well enough to invest in it. And if you can articulate it, you now have a document you can refer back to when your conviction wavers. At BlackRock, when we make a major thematic allocation for a client, we write extensive research notes documenting the logic. Years later, we can go back and evaluate whether the thesis played out as expected, what we got right, what we got wrong, and what we learned. This creates accountability and learning. Individual investors should do the same thing. It forces clarity of thought and provides a reference point for future decisions. Second principle. Diversification within themes is critical. Just because you have conviction about a structural theme doesn't mean you should bet everything on one company or one narrow expression of that theme. Healthcare spending will rise with aging populations, but that doesn't mean every healthcare stock will perform well. Some companies will execute poorly. Some will face regulatory challenges. Some will get disrupted by competitors. So you diversify within the theme. If you believe in the energy transition, you don't just buy one solar company. You own a mix of solar, wind, batteries, grid infrastructure, utilities, maybe some energy efficiency plays. You spread the risk across different expressions of the same theme. This way, if one company disappoints, the others can offset it. You capture the theme without taking idiosyncratic company risk. The same applies across themes. You don't put 100% of your portfolio in infrastructure just because you believe in the infrastructure supercycle. You balance infrastructure with healthcare, with technology, with energy, with other structural themes. You build a portfolio of structural themes that collectively give you broad exposure to the ways the world is changing while managing the risk that any single theme develops more slowly than expected. This is portfolio construction at the thematic level rather than the asset class level. Traditional portfolio theory says diversify across stocks, bonds, commodities, real estate. Thematic portfolio construction says diversify across structural trends. Both are valid. The best approach probably incorporates both. Third principle. Rebalancing thematic positions is different from rebalancing traditional asset classes. With a traditional 60/40 portfolio, you rebalance mechanically. When stocks drift above 60%, you sell some and buy bonds. But with thematic positions, rebalancing is more nuanced. You're not just responding to price movements. You're evaluating whether the thesis is still valid and whether the current price reflects an opportunity or warning. Let me give you an example. Say you own a position in renewable energy infrastructure, and it's up 50% in 2 years. Traditional rebalancing would say take some profits. But if you look at the fundamentals and the thesis is even stronger than when you initiated the position, if adoption is accelerating, if policy support is increasing, if costs are falling faster than expected, maybe you don't trim. Maybe the right move is to hold or even add on any pullback. Conversely, if one of your thematic positions is down 20% but the thesis has changed, if there's new information that undermines the structural logic, you sell regardless of the loss. You don't hold and hope. You re-evaluate continuously and adjust when the facts change. This requires more active judgment than mechanical rebalancing, but it's appropriate for thematic investing because you're making conviction-based bets rather than passive allocations. You need to stay engaged with the themes, monitor developments, update your theses. This is not set it and forget it investing. It's long-term strategic investing, which is different. Fourth principle. Understand the difference between structural trends and cyclical trends. This is where a lot of investors get confused. They mistake a multi-year cyclical upswing for a structural shift, or they dismiss a genuine structural shift as temporary cyclicality. Being able to distinguish between the two is critical. A cyclical trend is driven by the economic cycle. When the economy expands, demand for certain goods and services rises. When it contracts, demand falls. Housing construction, auto sales, business investment, these are cyclical. They go up and down with the business cycle. You can make money trading cyclical trends, but you have to be good at timing, and timing is hard. A structural trend is independent of the economic cycle. It's driven by forces that transcend the business cycle: demographics, technology, regulation, geopolitics. These trends play out over decades. They persist through multiple recessions and expansions. Aging populations, digitization, decarbonization, these are structural. They don't stop because GDP growth slows for a couple of quarters. The key question to ask: will this trend reverse if we have a recession? If yes, it's cyclical. If no, it's structural. Healthcare demand from aging doesn't reverse in a recession. It might grow a bit slower, but the underlying trend continues. That's structural. Demand for luxury goods might surge during an expansion and collapse during a recession. That's cyclical. Structural investors focus on structural trends and tolerate cyclical volatility. If you own infrastructure and there's a recession, construction activity might slow temporarily, but the long-term need for infrastructure doesn't go away. You hold through the cyclical downturn because you're invested for the structural upturn. Fifth principle. Position sizing should reflect conviction and time horizon. If you have very high conviction in a structural theme and a 10-year horizon, you can size that position larger than a theme where you have moderate conviction or more uncertainty. But you need to be honest with yourself about your conviction level. I use a rough framework. High conviction structural themes that I expect to play out over the next decade can be 5% to 10% of my portfolio each. Moderate conviction themes might be 2% to 5%. Low conviction or more speculative themes might be 1% or less. This ensures that my portfolio tilts toward my highest conviction ideas without becoming dangerously concentrated. And critically, position sizes should reflect not just conviction but also correlation. If you have 3 themes that are highly correlated, owning 10% in each gives you 30% exposure to essentially the same risk factor. That's concentration risk disguised as diversification. True diversification means owning themes that don't all move together, that respond to different forces, that give you different ways to be right. Sixth principle. Tax efficiency matters even more with long-term positions. If you're holding thematic positions for a decade, taxes become a major consideration. You want those positions in the most tax-efficient structure possible. For U.S. investors, that often means holding equities in taxable accounts to benefit from long-term capital gains treatment and qualified dividends, while holding high-turnover strategies or bonds in tax-deferred accounts like IRAs. It also means being very intentional about when you sell. If you've held a position for 11 months and it's up significantly, waiting one more month to get long-term capital gains treatment can save you 10% or 20% in taxes depending on your bracket. Over multiple positions and multiple years, tax efficiency can add 1% or more annually to your after-tax returns. That compounds to enormous wealth over decades. At BlackRock, when we manage taxable accounts, we use sophisticated tax optimization strategies. Tax loss harvesting, minimizing turnover, locating assets strategically across account types, timing distributions. Individual investors should think about these same issues, maybe not with the same level of sophistication, but at least with intentionality. Seventh principle. Stay humble and adaptable. Even with structural themes, things change. New information emerges. Technologies develop faster or slower than expected. Policies shift. Competitive dynamics evolve. You need to be willing to update your theses, to admit when you were wrong, and to adjust your positions accordingly. I've been wrong about structural themes before. I underestimated how quickly renewable energy costs would fall. I overestimated how long it would take for electric vehicles to gain traction. In both cases, I updated my views when the evidence changed, and I adjusted my positions. That's not weakness. That's rationality. The difference between being wrong in structural investing versus being wrong in short-term trading is that structural mistakes unfold slowly. You have time to recognize the error and correct it. If you bought a stock thinking earnings would beat and they miss, you're down 10% the next day. If you invested in a theme thinking it would take 10 years to develop and it's actually taking 15, you have years to re-evaluate and adjust. Time is on your side if you're paying attention. Now let me synthesize this into a practical approach you can implement. Start by identifying 3 to 5 structural themes you have genuine conviction about. Do the research. Write down your theses. Understand the drivers, the risks, the time horizons. Then figure out the best ways to gain exposure to each theme. Maybe it's specific companies if you have the expertise to evaluate them. Maybe it's sector ETFs or thematic funds. Maybe it's infrastructure debt or private market vehicles if you have access. Allocate to these themes in proportion to your conviction and your overall portfolio structure. If you're young and can tolerate volatility, maybe thematic positions represent 30% to 40% of your equity allocation. If you're older and more conservative, maybe it's 10% to 20%, with the rest in broad index funds and bonds. There's no single right answer. It depends on your situation. Commit to a review discipline. Quarterly or semi-annually, evaluate each thematic position. Has the thesis changed? Is the position still sized appropriately? Are there new themes emerging that deserve allocation? Are there old themes that have played out or been invalidated? Make adjustments thoughtfully, not impulsively. And critically, don't abandon the structural approach just because it underperforms in the short term. If you build a portfolio around 10-year themes, you have to give them time to develop. The first 2 or 3 years might be frustrating. The themes might be out of favor. Other investors might be making more money chasing momentum or trading volatility. Ignore them. Stay focused on your time horizon. I've seen this pattern over and over in my career. The investors who compound wealth over decades are not the ones who have the best year or the best 5 years. They're the ones who have pretty good returns consistently over 20 or 30 years. They're the ones who avoid blowing up, who stay invested, who align with structural forces, and who let time do the heavy lifting. Here's what I want you to understand at a deep level. The future is more predictable than you think, but on a different time scale than most people look at. I can't tell you what the stock market will do next month, but I can tell you with high confidence that in 10 years, the world will be using more renewable energy, consuming more healthcare, running more processes on AI, and operating with more resilient supply chains. Those are certainties. And certainties, even long-term ones, are what you build wealth on. So stop obsessing over the next Fed meeting. Stop trying to predict the next recession. Stop worrying about whether you should be in or out of the market based on valuations or technicals or some guru's forecast. Instead, ask yourself, what structural forces are reshaping the world, and how can I position my capital to benefit from those forces over the next decade? If you can answer that question and you have the discipline to stick with your answer through short-term volatility, you will build wealth. Not by being clever, not by trading, not by timing, but by aligning with the inevitable direction of change and letting that change carry your capital forward over time. That's the lesson of nearly 50 years in this business. That's what I've learned from managing $11 trillion through every kind of market environment imaginable. And that's what I'm sharing with you today, not as a prediction, but as a framework. A way of thinking that works regardless of what happens in the short term because it's grounded in long-term structural reality. If this perspective has value to you, if it's shifted how you think about investing, please share this video with someone who needs to hear it. Like it, subscribe to the channel, and let me know in the comments what structural themes you're most convicted about. Because the more investors who think long-term, who focus on fundamentals, who build portfolios around structural rather than speculative themes, the better the entire investing ecosystem becomes. The world is changing. It's always changing. But the direction of that change, the forces driving it, those are knowable. And if you align your capital with what's knowable rather than obsessing over what's unknowable, you'll build the wealth you need to live the life you want. That's not a guarantee. Nothing in investing is guaranteed. But it's the highest probability path to long-term success that I know of. And after 50 years, I know a lot of paths.